Brian Greer, and I'm one of the partners here along with Jeff. He and I have worked together for a number of years, here for about 13, 14 years, and in another business for probably close to another 7 or 8 years. So we know each other all too well, I guess. But happy to be with you here today. You can see Jeff heads up our consulting advisory practice. So, helping companies sort through a lot of sales tax related questions and issues. And I tend to focus a little bit more on the marketing, the partner alliance relationships and that type of thing. One thing that I'd encourage you to do, and Kate described it as well, but please throw your questions at us throughout the presentation. I did a presentation last week, and it was a condensed presentation. I'm not sure if anyone was on it, but I got 0 questions. So I assumed that I just did a fantastic job presenting the material, so there were no questions. But we definitely want to make sure we get some questions along the way that we'll be happy to answer for you. In terms of the agenda, you saw that the topic here was common pitfalls of sales tax. And these are things that, Jeff and I see not necessarily periodically, but quite frequently, in terms of different issues that our clients experience, and hopefully they experience them before they become clients. But for one reason or the other, whether it's a due diligence exercise or, maybe a sales tax audit pops up or they acquire a business, something happens and we get involved and we see some of these, these common mistakes and issues that people get themselves into that create some type of risk and exposure from a sales tax perspective. So without citing each one of these individually, that's kind of the focus here this afternoon, just to talk through those, provide you some examples, and again, answer any of your questions along the way. So before we get started, Kate, I'll flip it back to you here real quick for the first polling question, if you want to pull that up for us.
Yep. Thanks, Brian. Our first polling question here is going to be, how would you describe your level of sales tax knowledge, just to get an understanding of where everyone's at. So we'll just give you a minute to submit your answers there.
Yeah, while you guys are answering that question for us briefly, I'll give you a perspective, a little bit of background information on Tax Connects as well. I mentioned Jeff heads up our consulting advisory practice. We're really a professional services firm focused very specifically in sales tax. And there are 2 primary practice areas in the business: the consulting practice, where we deal with these nexus questions and VDAs and sales tax audits quite frequently for our clients. And then we also provide a compliance outsourcing service. So for those businesses that have a multi-state sales tax obligation, but they just don't have the skill set, the bandwidth, the desire to manage it internally, we're able to take that on as an outsourced sales tax function for them and prepare and manage the returns, remit the payments, just kind of keep up to date with the sales tax rules and regulations, and just manage that entire process for them. So that's kind of a quick perspective on the business. And Kate, I'm not sure if you had a chance to pull up the results and I just need to move on, or was that the next step here? I didn't see.
Here's the results.
There we go. Awesome. So we've got a fairly good mix, half the people, the intermediate level, and then kind of a split between entry level and advanced. So thank you guys for answering that first question. And I'll turn this first, pitfall or obstacle over to Jeff here regarding not recognizing or understanding your Nexus footprint.
Thanks, Brian, Kate. The thing that we always start with, whether it be a webinar, a conversation, or an evaluation of a company's activities, is Nexus. Nexus being sort of that connection that's required before a company has to comply for sales and use tax purposes. So the idea being, without Nexus, I don't really need to worry about sales and use taxes. And what has happened over the last 5 years is we've got really a new world order, so to speak. Economic nexus became a thing in 2018 when the Supreme Court affirmed the South Dakota legislation enacting an economic nexus standard for companies for sales and use tax purposes. So most of us now, 5 years into this, are pretty aware of it. It's pretty familiar to most of us. If you're not, that's okay. You're not alone. There's still a lot of companies that either aren't familiar with it or maybe misinterpret its applicability to their business. It's more common that technology companies find themselves in a dilemma when it comes to economic nexus, primarily because they have operated within the confines of their state border for so many years, and most of their business activities have been done electronically. So they haven't had the requirement of multi-state offices or multi-state employees, or even customer visits may not have been necessary. And so they kind of walk along or limp along, kind of doing their thing. Maybe in their home state, their software that they're selling isn't taxable, isn't subject to sales tax. So it never occurs to them that they may have nexus in another state, and more so taxability or tax requirement for sales and use tax purposes in another state, not realizing that in some states downloaded software and SaaS are exempt, in other states it's taxable. So what South Dakota did back in 2018, actually prior to 2018, is to legislate an economic nexus standard using two primary categories or criteria. One is a $100,000 threshold. Basically, if any company were to generate $100,000 in revenue from sales of products or services into the state of South Dakota, South Dakota would assert nexus exists, and that company would be required to comply with their sales and use tax laws, meaning they would have to charge and collect tax on taxable sales. The other aspect of this was a 200 transaction threshold. Now, South Dakota enacted that as part of their initial legislation, but they've recently repealed that aspect. So they're now only operating under the $100,000 threshold. But what happened is, after the South Dakota ruling by the Supreme Court, and we refer to that as the Wayfair decision more commonly, Wayfair being the company that fought this assertion. But a lot of the states that enacted their own economic nexus standard kind of followed suit with South Dakota. And that's why we kind of represent it here in the presentation as $100,000 in gross receipts or 200 transactions in a given 12-month period. So that's sort of the standard. Now, the reality is the states do vary in their application of the rule, and they vary in the threshold requirements. Some states, like California and Texas, it's a $500,000 threshold. A number of states either don't have a transaction threshold, or they had one and have since repealed it. We hopefully we'll find a day in the near future when all the states will repeal that transaction threshold. But again, it's looking at your business activity in 12-month cycles or in calendar year cycles, depending on the state, and determining whether you've met one of these criteria, one of these thresholds. And if you have to at least address whether or not you've got taxable sales in that state for sales tax purposes. As I said, the variability ranges from different types of thresholds. Sometimes it's gross receipts, sometimes it's taxable receipts, sometimes it's services and property. Sometimes the state will just say sales of tangible personal property that exceed a threshold. So there is some variability, but I encourage our clients and people in general to just kind of leverage that $100,000 threshold. And when you get there in a particular state, then dive into that state to see what the true threshold really looks like. In addition, the states all kind of enacted their own legislation at different times. So depending on which state you're involved in or looking at, you may have 4 years or 5 years worth of nexus. But in the case of, let's say, Missouri, their economic nexus standard didn't go into place until January 1, 2023. So you've only got 6, 7 months worth of nexus in that example. And there's a lot of variability in between. So understanding the economic nexus standard is really important, and I think is more critical than what we used to sort of use as a standard, which was a physical presence test. So prior to 2018, all the way back to the 60s, we were operating under a physical presence standard for nexus, meaning you had to have some physical activity or some physical property within a state before a state could assert its sales and use tax laws on the company. So those physical presence standards didn't go away as a result of economic nexus. They simply have refined the nexus standard to include an economic threshold.
So Jeff, one question that always comes up when we're talking about this economic nexus piece is that let's just pretend you're in a state that is a $100,000 in a calendar year, and so we're here in July, and I've now reached or exceeded that $100,000 mark. Do I have to do anything retroactive, or is it prospective only that I got to worry about?
It's prospective only, and even at that, there are variables that might exist in a given state. In some states, you might be given 90 days in which to register, in which case you may accumulate more revenue beyond that threshold during that 90-day period, but you're given some level of grace in that regard. But yeah, the way to think about it is once you hit the threshold, it then becomes incumbent upon you to determine your registration and compliance requirements prospectively, not retroactively. As we talked about physical presence, some of the standards of physical presence that we used to experience, or still experience rather, is obviously if you've got an office, if you've got employees located in the state, those are key factors. But it could also be employees visiting the state or traveling into the state for purposes of solicitation. Maybe they're attending trade shows. Those are all activities that can contribute or establish a physical presence nexus for sales and use tax purposes. Another one that's really relevant, I think, in today's world is inventory. So inventory is, again, another form of physical presence. If you've got inventory in the state, generally speaking, you're going to be deemed to have nexus for sales and use tax purposes. So we want to understand, particularly in an e-commerce environment like we have today, if we are selling tangible personal property, there's a pretty good chance we're leveraging a multitude of platforms, not the least of which might be Amazon. And we all know, or maybe those of us that have been doing business with Amazon for some period of time, that there are circumstances under which Amazon will hold your inventory and will actually move your inventory from state to state depending on demands and ability to get product quickly to customers. Historically, that has been a concern and had to be addressed for purposes of physical presence. So if I were selling on the Amazon platform and I had conveyed to them inventory of mine for purposes of selling, Amazon had complete control over that inventory, could move it into one state or another. We had to assume that wherever Amazon had warehouses, we probably had inventory. And as a result, we ended up having to register in a lot of states and comply. And when I talk about that scenario, there's kind of two key factors to understand. One is, if you're selling on Amazon, there's a strong likelihood you might have other platforms. You might have your own platform on which you're selling through the internet. So in that regard, the activity in Amazon could trigger nexus for your other platform, is the way to think about that. The other thing that kind of materialized as a result of the Wayfair economic nexus standard was that marketplace facilitators became subject to the same rules. Amazon being a marketplace facilitator. A marketplace facilitator is essentially a platform on which third parties can sell products, market and sell products, and that platform also transacts and accepts payment, processes payment for those products. So that's sort of the idea or the definition of a marketplace facilitator for purposes of the economic nexus standards. And a lot of the states virtually all the states at this point have enacted some degree of marketplace facilitator nexus on an economic level. And they tend to use the same threshold, $100,000. There are a few differences where the threshold might be higher.
And Jeff, we've actually got a couple of questions here more specific to the physical presence that you discussed here. Coy asks, is there a common minimum number of days physical presence test for employees visiting into a state?
It's a good question. It's something we've struggled with for decades because the majority of the states will use terms like frequent and recurring when they try to describe the activities that involve solicitation by remote employees. They don't tend to give specific numbers of days that define sort of the threshold whereby nexus is established. There are some states that do. For example, in Michigan, if you've got 2 days of that type of activity within a 12-month period, you've likely created nexus. Our philosophy has been, when we're advising clients, we kind of fall into a category of either 3 days or 5 days. 3 days is kind of the conservative approach. If you have 3 or less days, we like to believe that is not frequent. But when you look at the statutes in the states, you'll find that some of them don't have any real guidance or language as to whether any level of frequency is required, meaning 1 day of solicitation could be interpreted as having established or created nexus. So the reason we use that sort of 3 to 5 is it's historically been a reasonable number from what our experience has been under audit. The 5 days is something we commonly see CPA firms employing and law firms employing, a little bit more aggressive, but still I would say relatively reasonable. And the last piece of that equation is, you know, a lot of times when we're doing analysis and we're looking at the data and we see all the information, we have a pretty clear picture as to whether there was physical presence or not. The reality is the states aren't generally going to have access to that level of detail. There's just not a good place to go find how many times in the last year did I send an employee into North Dakota to solicit sales. That's a hard thing to prove. So in reality, the states are probably woefully behind in being able to identify and assert any level of frequency. The flip side to that would be that the state doesn't have to necessarily prove it. They can just assert it and then force you to mitigate it or go through legal channels to try to fight it. But I would just encourage you to think about it from a 3-day perspective.
Yeah, I think it's one of the probably main reasons why the economic nexus thresholds are attractive, just from the perspective that they establish a relatively bright line distinction as to whether you've reached a certain threshold or not, whereas the physical presence can be very nebulous and interpretational. One other quick question before we get to the poll. In the same vein as the previous question, if a remote employee is not involved in selling functions, does that still establish a physical nexus for you?
Generally, yes. There are a few exceptions out there, but if you've got a remote employee that's working in the business or on the business, whether they're client-facing or not, I would just assume you probably have established nexus. Some of the exceptions might be that you might have somebody that's got a vacation home in a particular state and they're visiting there for a few months a year and they're doing work from that house. I don't know that would be something a state would pursue. The other thing that really came to light under our COVID experience was those companies that sit close to borders, where they have employees that are traveling across borders to work, at one point in time were left to work remotely. In a lot of cases still are working remotely. So in some of those cases, the states have actually come out with some administrative policies saying that under those conditions, that employee being resident in a different state does not create nexus. So again, like anything with sales tax, it kind of depends. We'll have factors that are very meaningful in one state, not necessarily as meaningful in another state. But I would encourage you to kind of think about an employee as having created Nexus for you.
Regardless of what activity they're involved in.
Regardless of activity.
Perfect. All right, Kate, I think we're ready for the next polling question here.
Yep, so our next polling question here is, when thinking about sales tax, what is your biggest concern? It's always interesting to see what businesses are struggling with the most when it comes to sales tax. So again, we'll give you a minute to submit your answers there.
Yeah, and I think this will be a good opportunity to take one more question here from the audience. This one's a little bit detailed, so I'm going to pay attention here. If a virtual training takes place where the trainer is located in New York, but 2 trainees are located in New Jersey, and 2 are located in Pennsylvania, does this only establish a physical presence in New York? So it sounds like the trainers are in New York and the attendees are in New Jersey and Pennsylvania. Where does Nexus exist in that scenario?
Yeah, and by attendees, I assume you mean the customer that's receiving the training, maybe paying for it. Your physical presence under those conditions is in New York. Your economic presence is going to be in those other states where the trainees are located. So there's kind of two-pronged scenario there.
Yeah,
I'll keep that answer short. Do you feel like that's?
Yeah, I think so. And only the economic presence would only be relevant. The measurement for economic presence would be in New Jersey and Pennsylvania.
Correct.
We're not saying economic nexus has been established, but the revenue generated from those 2 attendees and the invoices sent to those attendees contribute to the measure in those 2 states.
Correct. And just to add a little bit of additional color to that, because there's certainly a lot of different types of services that could have a similar fact pattern. We really use the idea or the theory of benefit of service. Where is the benefit of service being received? And that's where we would want to cite as our revenues for purposes of the Nexus threshold.
Perfect. So it looks like a combination of keeping up with Nexus and taxability rules is 70% of the audience in terms of their level of concern and what they think about relative to sales tax.
Yeah, we'll talk. We'll bring taxability into the equation here in just a bit. I think when we talk to companies, or we've experienced this, I should say, who have attempted to comply, they've found themselves to have established Nexus, or they've been in a certain business transaction or transactions across a number of states that required them to be registered for sales tax purposes. And some of the disconnects that we found with these experiences are there might be a client or a taxpayer who is selling to an entity and they're making a pretty significant sale. It's a material transaction for the company. So they want to do whatever they can to close the deal. And the customer says, well, we want you to charge us sales tax. And the company says, well, we're not registered there. We don't have Nexus there. We're not going to have a requirement to file in that state. But the customer demands that they charge sales tax. So the taxpayer decides, okay, I'll go ahead and register. I'll charge tax to this customer, but I'm not going to comply prospectively. I'm still not triggering Nexus. I haven't necessarily exceeded that economic Nexus threshold, and I don't have a physical presence. Well, just by being registered, essentially you've established Nexus. Once you register for sales and use tax purposes, you have an obligation to comply with the sales and use tax laws of that state. Now, it could be that you don't have any additional sales into the state, or any of the sales that you do have, none of them are taxable. And so there may not be any liability per se, but once you're registered, you will be assigned a filing frequency. And whether or not you have any taxable sales or non-taxable sales to report, you've got to maintain the filings on that filing frequency. So if your filing frequency is monthly, you still have to file monthly, whether or not you had any activity in that prior month. If you fail to do that, some states have some pretty basic automatic penalties that might apply. It could be something fairly immaterial, like $50 a month, but still those things can add up, and it really can get messy over the course of time, particularly if you've got a number of states where this sort of activity is taking place. The other thing to keep in mind is even if you haven't had taxable sales, to the extent your sales are exempt for purposes of, let's say, resale, or you're selling to a nonprofit entity, it's still incumbent upon you to obtain the appropriate exemption certificates to substantiate that exemption. Just maintain that information such that under audit you can justify the exempt treatment of those transactions. And then lastly, gross receipts. Now I'm going to talk about a couple of different scenarios here with gross receipts. There are some states where there's a gross receipts type tax. Washington has what's called a business and occupations tax. So even though I may not have any taxable sales for sales tax purposes, if I'm registered in Washington, I'm going to have a business and occupations tax filing requirement, and there will be a tax amount due if you have any revenue. So that's one aspect. Another aspect of gross receipts is there's usually a question about how do I file my returns. So let's say I've operated in the state, I'm registered in the state, I've had some sales, they've all been exempt. I made $25,000 in exempt sales last month. Do I need to report that on the return and show it as exempt? Or can I just put zeros all the way across the return? The law, the administrative policy, and the legal policies of the states would say you need to report that $25,000 and show it as exempt sales. You won't have any tax due. The challenge that some companies face is that those gross receipts under audit are a lot of times compared to income tax returns and financial statements. And there's always variables that make those unreconciled. So at the end of a year, you might have $480,000 in exempt sales for sales tax purposes, and your financial statements may show $700,000. That could be because you're selling software licenses, and for that particular state, you're forced to accrue that revenue and recognize it in that year. But on sales tax, you haven't even billed for it yet. So there can be some reconciling issues that surface during an audit. We've seen that over the last year with 3 different clients. And what happens essentially, and usually the numbers are really large, but what happens essentially is the state or the auditor just comes in and says, look, I see millions of dollars on your income tax return filed with the state. I see $100,000 on your sales tax returns as gross receipts. That doesn't reconcile, and they'll simply assess tax on the difference. So one of my clients got assessed $640,000 in tax in Florida for this exact reason. Another one had the same experience in Tennessee. It's a lot less money. I think it was a couple $100,000 in that example. But it required a great deal of effort to reconcile for the state, for the auditor, to get them off of that assessment. So the alternative would be I'm not going to report my gross receipts on my sales tax return if they're all exempt. I'll only report my taxable receipts. Well, under audit, that may not be something they agree with, but there's not a whole lot they're going to do about it. They will not be stuck in an unreconciling situation at that point. They still will say, prove to us that all of your receipts reported on your income tax return were in fact exempt, and they will still try to reconcile back to your GL. But in any case, there's a little bit of flexibility, I would say there, practically speaking, not legally speaking. And so just be aware that the requirements and obligations are established once you're registered. The other category I think that was recognized in that poll question as a headache is taxability of products and services. And we do tend to kind of segregate the analysis of nexus from the analysis of taxability. Some of our clients will get a little confused with the difference between the two. They kind of get the impression that if I have nexus, I have taxability. No, you can have nexus and have no taxability. Tax Connects, we're based here in Georgia. We clearly have nexus in Georgia, but we don't have a registration requirement because none of our services are subject to Georgia sales tax. So it's clear that I have nexus, clear as well that I don't have any sales tax obligations. So, but the thing that really does challenge us all is the variability, the nuances from state to state in terms of taxability. Generally, all the states that have a sales tax will apply that tax to tangible personal property. Retail sales of tangible personal property are generally taxable. However, when it comes to services and sometimes digital property, there's a good bit of variability state to state. So you really have to drill down on your specific products and services to determine whether or not they're taxable from one state to another. When we get into services, there's certainly a number of categories and industry segments that are more complex. Manufacturing is probably one of the more complex. A lot of the states afford manufacturers exemptions when they're buying raw materials. They may get exemptions when they're buying equipment, manufacturing equipment, and there may be other ancillary exemptions. Could be their warehouse might qualify for some exempt treatment from a sales tax purpose. Construction companies, generally speaking, real property improvements are a service, and in a lot of states, that general revenue is not subject to sales tax. What happens in the construction industry is that the contractors pay tax on the materials when they acquire them for use in the performance of a contract. But again, that varies from state to state. There are some states that do tax the gross receipts of contractors. And then there are states like Texas where a remodeling contract is subject to sales tax, but a new construction contract will likely be exempt from sales tax. Still, the contractor has to pay tax on the materials on that new contract. So a lot of variability, a lot of nuances. The real message in all of this, and then this is especially true for technology businesses that are selling software and digital products, don't assume your home state is sort of the standard. The default in a lot of ways, in a lot of cases, can be just that. We get comfortable in our home state. We've been operating there for years. We have a pretty good idea as to what we're doing. We've been audited, and we know what the rules are now. We tend to want to apply those same theories across other states, and it's a dangerous place to be.
All right, so Kate, I think this is the third polling question. If you want to pull that up for the audience, please.
Yep, so our next polling question here is, how is your business currently managing compliance, or are you?
Great, we'll let the audience answer that question. And Jeff, one question to you. In the previous slide, we talked about exemptions and exclusions. Is it safe to say any exemption requires some type of form or certificate from the client or the buyer, or would exemptions apply in the absence of a form or certificate from the customer?
Generally, an exemption is going to require some type of an exemption certificate. And what Brian was alluding to when he talked about exclusions versus exemptions, when I described the Tax Connects business here in Georgia, we're a professional service organization. Our product and service deliverable is not subject to sales tax. There's no reference to it in the statutes. So we like to say that's excluded from sales tax. There's no inclusive activity that would mirror what we do. Exemptions are otherwise taxable transactions, but for the fact that the end user is using it in an exempt fashion. So if a retailer like Walmart is buying a bunch of vacuum cleaners to put on their shelves, they're buying those for resale. That's a resale exemption. They would have to issue an exemption certificate to their customer, or to their vendor, I'm sorry, for that purpose. So the only real exemptions that don't require any type of certification would be sales directly to the federal government. Generally, there's not a need to obtain any type of exempt certificate for that. The only other one that's fairly common is in Texas, if you're selling to a public school district, and that's the clear customer name on the invoice. The state of Texas allows that invoice or the purchase order associated with that invoice to qualify as the certificate.
Perfect. So looks like a lot of the audience is using some type of technology to manage the sales tax process. And certainly find that to be a very prevalent option. We won't get into the details right now, but I think automation in sales tax absolutely has a place. It's not necessarily the complete answer for all scenarios, but definitely has a place for a lot of clients. So glad that a lot of people are managing that effectively. I think the next topic here, Jeff, is about voluntary disclosure agreements.
Yeah, the last two topics, we're kind of migrating through the life cycle of compliance for sales tax purposes. You know, we started talking about Nexus as kind of the first step, the first roadblock or toll gate. And then we talked about taxability determinations and the variability from state to state. We're going to kind of back away from that now. We're going to kind of assume we have Nexus. Let's assume we have taxable products and services in multiple states. And these last two topics are going to talk about what do we do if we need to mitigate some historical risk and liabilities and exposure. And lastly, we'll talk about what if we're audited by a state and how do we need to react to that. So the first topic is VDAs. That VDA stands for Voluntary Disclosure Agreement. And really all the states have some sort of formal, even if it's just administrative program that affords taxpayers to come forward on a voluntary basis to disclose the fact that they both had Nexus as well as taxable sales in the past. Now, VDAs can apply to companies that have not been compliant. If you've been registered before, generally the VDA program does not afford you opportunity to participate. If you've been contacted by the state in the past regarding sales taxes, you're typically disqualified from participating in the VDA. But you could have been charging and collecting tax without being registered in the state. And under those conditions, without having been contacted from the state, you would generally qualify for the VDA program. The VDA programs are fairly similar. They all sort of contain two primary benefits. One is penalty abatement. It's kind of a standard protocol. Now, generally, if you've not charged tax, penalty abatement is automatic. If you have charged tax, but you've never registered and failed to remit that tax, there can be some minimal penalties associated with those types of scenarios. Interest almost always is going to apply. So whatever your liability is over the course of whatever periods are involved, you will have an interest component associated with that. But the other primary benefit is what we refer to as a limited look back. And a limited look back is essentially the state agreeing to give you the benefit of a statute of limitations. And what that looks like is if I've been operating for 5 to 6 to 7 years in a state, I've had Nexus during that entire period of time. I've made a lot of sales, a lot of which are taxable. I haven't collected any tax, but clearly if the state were to audit my books and records, they would find it reasonable to assert I had Nexus and assess me on that 5 to 7 years worth of liability. Well, under a VDA, what the state's going to agree to is giving you general statute of limitations, and it's usually 36 to 48 months, meaning anything within that 36 to 48 month period is going to have to be disclosed and paid along with interest. But anything in that 4th, 5th, 6th, 7th year in terms of risk and exposure, the state's going to basically forgive it so long as you didn't charge tax and collect tax. So that's the primary benefit to doing a VDA. We encounter a lot of companies that are going through different stages of their business cycle. Maybe they're getting ready to go through due diligence. They're looking to have a liquidity event. Maybe they've already gone through due diligence and they've been instructed or there's been a demand for them to do some type of disclosure. There's a number of things to consider when you're looking at prior period exposure and risk, and there's options to dealing with that. You could go in and simply register with the state and say, I should have been registered 2 years ago. I'm going to register telling you that. What the state's going to say in reaction or response to that is, we need to see returns for every month or every quarter from the point in time in which you've had Nexus to today. That's not the best option. It's usually a fairly expensive option to execute. Not a lot of benefit in it. So under most of these conditions, it's either do a VDA or maybe do nothing. And when we say do nothing, what we're really saying is, look, I've looked at my books and records. I did have Nexus. I had Nexus 3 years ago. I've had taxable sales, but I have not charged or collected any sales tax. If I go down the VDA path, I've got to disclose all of that liability and pay all that tax. That is something I can't afford. But I do have to get into compliance. I need to be charging tax prospectively. I want to do the right thing. I just can't afford to do that VDA. So what a lot of companies will do is simply register prospectively. A little bit of a tricky situation completing the registration documents, but it's sort of the way to go forward, get yourself voluntarily compliant, and there's a little bit of a cross your fingers approach to that. You should anticipate the potential that you would be audited and that a state could go back to those other 3 years and they could assess you all the tax due and they would apply penalties and interest. The likelihood is, even if that does happen, the state's probably going to give you some relief from the penalties. So when you compare that scenario to doing a VDA, there's basically a wash. There's just not a whole lot of benefit to doing the VDA under those circumstances. But again, there is some risk. The liability doesn't go away. It continues to sit there until such time as the state decides they're not going to go back that far. So a lot of strategy when it comes to mitigation options when you're in a position where tax is due and you haven't collected it. When tax is due and you have charged and collected it, but you haven't reported it, you've got to get that tax paid back to the jurisdiction somehow, some way, whether that be through the VDA or any other option. You cannot be caught red-handed with tax in your GL that you've collected from a customer. Those are trust funds that you're operating as an agent on behalf of the state when collecting them. Those are the state's funds that you're holding. Not a good place to sit.
Hey Jeff, let's stay here on VDAs for just a minute. We've got a couple of questions. So we've got one question is, what does contact by the state mean for this VDA purpose? Is that related to specific requests for data or audit, or would a generic letter count as contact?
Yeah, if the letter is referencing that tax type, we're talking about sales tax today, so if there's a reference to sales tax, you should assume you've been contacted. It doesn't mean there aren't still some options, and it doesn't mean the state might not still work with you in a VDA capacity, but the general rules and requirements as outlined by these VDA programs would tend to disqualify that taxpayer if there's any reference to sales tax in that content. There's some other tricky scenarios, but let's say it was a property tax notice or a payroll tax notice is probably more likely. That would not disqualify you from a sales tax VDA. I had a call this morning with a company who's considering doing a number of VDAs, and they were asking some questions about some particular states, and we started talking about, they asked about Michigan, and Michigan has sort of a funky rule. They have an annual report that has to be filed for, and it's a combined report for both payroll and sales tax. And what's interesting is that if you've never registered for sales tax purposes and you've never charged sales tax, but you had an employee located in the state, you would have had an obligation to file this annual report. And all you're doing is regurgitating the same data that you've been reporting throughout the year. There's usually no tax due on this annual report. However, because it's a combined report, the state, if you try to go down a VDA path and you've been doing payroll taxes for any period of time, they will assert that you're not going to qualify for the VDA program because you filed a report that has sales tax written on the report. It's a really weird scenario and tricky one, but not a lot of those kind of things out there.
All right, so one other VDA related question. If we determine we should have been collecting sales tax and a VDA would be advantageous, should we wait until we submit a VDA before we start to charge and collect sales tax?
Yes, you should wait. And when I say wait, what I encourage our clients to do is let's get an application submitted. Once I get an application for participation in the VDA program submitted, we're comfortable from that point forward or after that submission starting to charge and collect tax prospectively. And even during that application review process by the state, we might also go ahead and initiate the registration. So we'd like the registration timing to correlate to when the tax starts to be charged. And those things can be done while we're anticipating a response from the state to our application.
All right, so I think this is our last topic here regarding audits.
Yeah, so let's, typically an audit can occur whether you're registered or not. The question I get a lot of times is, well, if I'm registered, aren't I on the radar? Aren't I more likely to get selected for audit? I think the logical answer to that is probably yes. But it's important to note that a lot of audits are determined and identified through the audits of other companies. And what that means is while your customer is being audited, the auditors are seeing your invoices to your customer. And they're drawing some conclusions. They're painting some pictures in their mind as to whether or not you are a taxpayer that has nexus and has a responsibility to comply. And it's very likely that you might get a phone call, that you might become part of their next audit program. So the thing to think about from sales tax purpose or perspective is prepare yourself and assume that you're going to experience an audit. We don't go into a lot of detail around documentation. We did touch on exemption certificates today. Make sure you're getting exemption certificates from all your customers. I encourage my clients, even if they're not registered in a state, if they're selling to a nonprofit or to a reseller, I encourage them to go ahead and request the exemption certificate anyway. It's just an added layer of insulation and protection should the state come in and assert nexus exists. The reality is if you're operating in the state and the state does assert that you have nexus and you don't have any documentation to support exempt status, the state's going to assume it's taxable. And that's typically true regardless of how obvious the invoice looks. If I'm selling 10,000 vacuum cleaners to Walmart, that might be a bad example. Most states would probably let that one slip. But you should assume that form overrules substance. So even though the substance of that transaction is most likely, if not clearly, a resale exempt status, the form doesn't exist. We don't have the exemption form executed by the customer. And without that, it's taxable. The other things to think about when you're dealing with audits, an audit is not a bad thing. Again, it's something you should just anticipate experiencing at some point. Those of you, and I'm sure there's a lot of you on the call that have either had the opportunity to manage audits or maybe you have some going on right now, not a whole lot to be afraid of. Obviously, we're always nervous because we don't know what might come of the audit, and certainly we don't want an assessment. But it is important to follow a few, I think, key sort of policies. One, have your processes well documented. Be able to speak to them and illustrate for an auditor how the process of sales tax is working if you are compliant. There is going to be some questions about sampling. There are different approaches to sampling and projecting when it comes to audit data. The larger companies, in today's world, we're seeing the states leverage technology, and they'll bring in a technology person that's specifically trained and experienced with statistical sampling audits, and they'll ask for 100% of your data and push it through that technology to set their audit sample. There still are a lot of samples that are set by the auditor. Could be a block sample. They might pick 2 quarters out of 2 years. They might pick 1 month out of each year. There's all kinds of ways they could go about it. You should really analyze whether whatever sample is chosen, whether that sample accurately reflects the true activities of the business or where there's special circumstances during that sample period that have to be taken into consideration. And then it's important to just have one point of contact for your audit. You don't want multiple people answering different questions or maybe answering the same question differently from an auditor. So instruct that auditor, introduce them to a single point of contact. That's the only person that can answer questions for the auditor, for the company, and keep that streamlined. And lastly, you know, you go back a few years, we used to make fun and joke around about doing neat things to auditors, putting them in the hottest room in the building, you know, depriving them of any luxuries. I think they're just trying to do a job. Some of them better than others. We all know that. But I think it's better in the long run to just treat them with respect, try to provide them with what they're asking for. There are times when it can become very challenging because they're not necessarily understanding what you're trying to communicate, and they won't move off a topic without being convinced. Just be aware that you'll have opportunities further down the road and up the chain to try to mitigate that situation. So fighting with the auditor at some point is futile and not probably worth your time. So I think it's best to just treat them with respect. It's a transaction that's really happening. And to the extent the auditor is incompetent, which there are some, you can have your day in front of a more qualified person to mitigate.
All right, so Kate, I think we've got our last question if you want to pull that up. I think it's just asking if anyone wants any specific follow-up from us. So if you could answer that question and let us know. We'll get to the last couple of audience questions here as we wrap up. This first one talks about or asks, can you mitigate sales tax liabilities by proving the customer paid use tax?
Yes. There's you can get an affidavit signed by the customer detailing the invoices and the amount of tax with enough evidence that they are a registered taxpayer and had the ability to pay it. We refer to those affidavits as XYZ letters. It's a fairly common term across the industry. Auditors a lot of times will recognize that terminology, but essentially it's just an affidavit from your customer. There actually are some states, like New York has a specific form whereby if you've been audited by the state for that same period, it's presumed that liability has been satisfied, and you can fill in that form, or your customer, I should say, can fill in that form and send it to you. In fact, I think that form might be something the state gives you at the end of the audit, and you can just kind of forward it to your vendors under those circumstances.
All right, and the last question we have here, in calculating the liabilities, at what threshold does your risk of audit increase? Are there any liability amounts that are less likely to be audited? You know, the strategy around sales tax is predominantly driven by materiality. Materiality is something that isn't well defined or isn't defined at all. It's a theory. Everyone's materiality level is going to differ. I can't really give you any kind of picture as to what level of transaction would trigger an inquiry or an audit. It's more of a feel. Brian may not have mentioned this. I was an auditor with the state of North Carolina in the early 1990s. It's been a long time. A lot's changed since then. But I was there for about 4 years. And I can tell you that every invoice had the potential of triggering a subsequent audit or creating some questions. And it could be a $500,000 invoice, and it could be a $500 invoice. So I don't know that there's an easy answer or a good answer to that question. It could be I'm misunderstanding the question as well. So if we are, happy to follow up with you separately. But I do think, we have a lot of conversations with clients where we'll talk about the fact that they have nexus. We'll talk about the fact they have taxable sales in a state, but we'll then say, yeah, but your materiality level
doesn't rise to a degree that I would call it necessary to comply. The cost of compliance might outweigh the risk or the exposure. And that's all well and good on a 1 or 2 year sort of span of time. You just have to remember there's no real statute of limitations if you haven't been filing. So if you take that approach and you use sort of a materiality threshold, recognize that it's an accumulating effect. So year over year, you've just added to your risk and your exposure. At a certain point in time, it may become material.
Yeah, that sounds good. And if we didn't fully address that question or any of the other ones, you've got my contact information here if you'd like any further dialogue or thoughts on some of your sales tax questions or issues there. So we'll go ahead and wrap up here. Thank you, everyone, for attending. We appreciate it, and we look forward to hearing from you, seeing, I guess neither. I guess we look forward to you attending future webinars. Thank you. Bye-bye.
Thanks, everybody.